Started. Okay, there we go. Okay, we are in bull normal conditions. Let me get my arrow up here. We're in bull market conditions. On the weekly RSI, we are at 67, so we are at the, in the upper half of neutral. On an annual basis, on a 10-day basis, we're at 89 on the 10-day index, so we're overbought. The 200-day moving average is at, the percent stretch above the 200-day moving average is at 12.10%. That's bullish, and we're back into the green. So this little rebound we've had in the last week or 10 days has brought the market back up into very strong conditions with respect to the 200-day moving average. Similarly, the slope of the 50-day moving average has improved to 0.35. That's positive. That's up. And that takes it out of the red and into the yellow. You may recall we were in red condition last week. The ADX dropped from about 24 down to 18.7, which is not a trending market. The good news is that last week when it was at 24, it was because of the bearish price action, and now the improvement in bullish price action has actually weakened the ADX and brought it down to 18.7, and the plus DI has improved over the minus DI, so we actually have a market that is healthier, getting healthier, and with the trend being measured at 18.7 on the ADX, that actually means that there's room for a third leg up from here. Now all it has to do is keep going, but there is room for it to actually get an extended move up because of the size of this pullback. The ATR percentage has dropped to 1.24%. When we look at the daily, we'll see that the price improvement of the last 10 days has come in conjunction with declining volatility. So once again, we see that there's an inverse relationship between volatility and performance. All of the equities have clawed their way back after 2 weeks of disaster in Japan and the Middle East, and this in spite of rising oil prices. Precious metals and any kind of commodity are still dominating, especially silver and energy, although we're going to see that agriculture and blended commodities have actually pulled back into a nice buying position as well. Monthly rebalancing from this week, 331 is holding DIA, MDY, and IWM, and MDY and IWM were strength leaders from last month, so the only thing that gets swapped out is DIA. DIA has been actually pretty strong compared to SPY here. 631, which looks back 6 months, is holding SPY, MDY, and IWM. The quarterly rebalancing, because of the way it looked, it looks back 3 months, is identical to the 331. So it's holding diamonds, mid caps, and U.S. small caps. Under ETF2, we will be adding 3 positions, and that brings the model portfolio into alignment with the theoretical exposure at 70%, because 7 of the 10 major indexes are positive on the 5-week rate of return. So the 3 buys are going to be RJI, which is blended commodities. Now, if you put that up on a chart against DBC, the Deutsche Bank blended commodity mix, you'll see that over the last 2 years, RJI has been a better return when commodities are working compared to DBC. It's a slight but persistent advantage. Excuse me. RJI has a slight advantage over DBC in that it is a better blend of a variety of commodities. DBC is pretty heavily weighted in energies. It's about 50 to 55% of its components are directly tied to energy. So it's a little, it's actually secretly an energy commodity. So all of the stops there's 3 positions in the energies and 1 in silver, and all of them made new highs this last week, and so the stops are to be updated in ETF2. Moving on. That just showed this second chart shows the 331, 631, and 333. Now, a month from now, before next month's rebalancing, I will have completed my back testing on the monthly rebalancing. I am going to be making a slight change to the published document by having a blended mix of 3-month look back and 6-month look back. I'm going to be adding a handful of ETFs to the ownable universe to account for some additional decent choices for us. And I'm going to be adding a filter in that says it must be positive over the 4-month moving average in order to buy it. And what that will do is in our back tests over the last 10 years based on the mastermind work on the rebalancing, that could double or triple the returns and cut the drawdowns in half. And it would have been you'd have been very happy in 2008 and 2009's major bear moves with that kind of a strategy. And we're going to put a cash and a short side fund in it for those that want to take a little extra. Take an extra shot at some gains. And now the good news is that because the way the math is constructed, the 3 symbols in the quarterly and the monthly lookbacks of any type would be the same ones this month as if we had implemented the rule set this month, because they're all above their 4-month moving average. And they still would have been leading contenders compared to the new ETFs that we plugged in. So we don't really lose anything by doing an extra month's worth of back testing. But this is, a grateful nation reaches out to the guys in the asset allocation mastermind who have been doing a lot of great work with the basic models that we present in the seminar and making some robust tweaks. You get 10 or 15 guys working pretty hard on that, and they're going to, and I'm really grateful to the work they've done. That's going to go into one of the future bundles on the TradeStation, and I'll be providing a spreadsheet that allows you to run that report yourself. So moving on. So thanks to the guys in the mastermind, you've done us all a very great service. So chart number 3, we're going to take a look at the health check for SPY. And again, we're looking at the vertical blue lines are 1, 2, and 3 weeks of, 10, 20, and 30 days look back. The black line in the middle is the slope of the regression line, the 30-day regression line, which you see has now come back to almost flat. And then the outside black lines are the regression line channel that represents the greatest excursion from the regression line in that 30-day look back, and you can see the big sell-off on somewhere around 15 or 16 February is what causes that channel to be so wide. The purple line at 135 is the previous swing high, and then the first red line is the 5% pullback from the swing high. Anything between 0 and 5 we treat as random noise. And then between 5 and 10%, we have what is typically called a correction in a bull market. And it came down and touched that 10% pullback and then has bounced ever since. You can see from Williams %R that it had triggered a channeling pattern at that point. And so there's been quite a nice move. The price is now better than the 10-day moving average, and the 10 is now better than the 50. The 200-day moving average is still 12% below. Mike asks, does SPY reaching the recent swing high in February concern me? Well, it does in the following sense that everybody now can see that we're at the top of this 1 month long trading range. It went from 135 down to 125. It is now back to almost 135 again, and so that represents that little V bounce right there. The market is poised on a knife edge right here. Now, for the next leg of the bull to ensue, it has to get above 135 and continue. Now, there's room. The good news is that there's room for it to do that, because this last 30 days has not really been very good performance. It's basically been sideways, and that comes after a 4-month bull. So you have 4 months up in a row, 1 month of pullback, and now it's back up to the top of that channel. And now with the ADX at 18, there's room for it to have a 2-week run to extend this little bounce, and we could see another 6 to 8%. A 8% move up from here would put the percent stretch at 20. We would still be within the upper limits of bull markets. The best percent stretch above the 200-day moving average that SPY has ever had is about 24%, and we're only at 12% right now. And so that means that the market in the past has been able to go another 12% from this particular position. And so what could trigger that? I mean, you insert your reasons here. Continued troubles in Japan and the Middle East, and flight to quality. And now the Republicans are talking about a budget where they propose to cut $4 trillion out of the next 10 years of budgets. Well, if that happens, that's going to be money that goes into the economy, and we'll see money coming into the U.S. No matter what it does to our social programs, that will be seen as a favorable move by capitalists, and you could expect to see a leg up from here. Conversely, I can also make the argument that it could go down and test 125 just as easily. In fact, we've already seen it in this past month, and you can just insert the reasons why it might do that. So my concern as a short-term trader is simply just frame my trades, take my shots, manage my risk, and not really worry about the larger issues. As an intermediate-term trader, I will tell you ETF2 is buying right now because it's going from 30% or 40% to 30% to 70% exposed. So the whole market is actually getting favorable here. There is strength in emerging markets and Latin America, and the commodities have pulled back a little bit here. So there's room to go, and it happens. So I think we're right at a potential turning point in the market. We had a doji on Friday, and you can frame a trade equally well in either direction. But all signs point to favorable right now. We're in bull normal conditions. It's pulled back from bull volatile. The slope of the 50 is up. The 10-day has moved back above the 50. In retrospect, it looks like that was just simply a correction in the market. So I'm ready to pile on if price gets through 135. Until it does that, I'm going to have a short-term outlook and be very tactically oriented. But if it gets above 135, the bull is back, and I'm prepared to really pile on the long side on the strength leaders. So that's my read on this one right now. There are many favorable conditions, however, for follow-through. I consider this tactical traders that got it from 125 to 134, and now we've got to see institutional money commit in order to get it through that 135. If it gets through 135, I'll tell you, there's a lot of conservative technical traders who will see that as a very favorable sign, a breakout from the trading range, and then you'll see money pile on to the large caps and in the U.S. And then I would expect to see technology and small caps really start to dominate, because the mid caps have been leading the way. Technology has been the weakest of the U.S. sectors, and we're going to see charts of interest in Microsoft, Hewlett-Packard, Walmart, and Cisco. Those things have not yet participated in this bounce. And so I would expect to see money flowing into U.S. tech if SPY can get through 135. And that means we could have targets on those, or also on symbol QLD, and really do well. So good question. Hopefully that answer helps a little bit. Wayne asked, would I wait for a move above the February high to pull the trigger on 331? I would not, because I've already pulled the trigger on 331, because that is a pure mechanical system that executes on the first trading day of the month, and I just follow the rules because that is an intermediate term system. I use my discretionary and short-term trading to take into account these little technical things like the, what price is going to do at the swing high and so forth. So for me, that's a different pile of money. Okay, moving on now to ETF2. We've got the 10 regional indexes. You can see Japan is just horrible here in the red still. Green showing up under the strength for emerging markets. They have bounced back even better than SPY, and especially in ILF, Latin America, and EWZ, Brazil. Those are components inside of the EEM, and you can see ILF is pretty strong at 52. It's better than the U.S. right now. 4 weeks ago, ILF was lagging way behind SPY, and now it and Brazil have both pulled ahead of SPY. Ali asked, IWM's already above its previous high. How does it play into our outlook going forward? It's stronger than SPY. It's made a new high. It's one of the 2 or 3 strongest of the ETFs. And so on any day that SPY is up and that small caps are doing better than SPY, it's easy for me to pile on UWM, the double leverage small caps. As long as they're doing well and they're better than SPY, just keep going. It just reinforces that same posture. There has been money flowing into the U.S. as a flight to quality, and small caps are better than large caps, so when they're going up, buy them. Simple. Well, not simple, but straightforward. So 7 of the 10 regional ETFs are green on a 5-week rate of return, so that gives us the 70% invested, 30% cash posture in the tactical model. Only U.S. mid caps at 72.3 are exceptionally strong according to RSI, the weekly RSI. So all the other ones still have plenty of room to go. And that's what you get when you have a 30-day pullback like we've experienced, that it's created a viable dip because there's been 30 days of underperformance and cash being raised. And now that cash that was pulled out of the market in those 30 days is ready to go back in. And the leading candidates right now are, well, the U.S. is better than the rest of the world. SPY is better than EFA. The U.S. sectors, mid-caps are better than smalls, or better than large, or better than the techs. I actually expect the techs to do better if we see money coming in. Strongest are MDY, mid-caps, and EEM, and the weakest are Japan and Asia less Japan. The world market model is up next. And we're on page 6. And so I look for red and green on here. You can see that in the U.S., small cap growth is positive. So getting to Ali's point, if I saw small cap growth fund better than the SPY, I'd pile on that one. Mid caps have been the best, followed by the small caps and then large. Now, over in the Asian countries, you'll see a separation of the leaders. South Korea, India, and Australia are in the green. Now, you may recall about 2 months ago that India had a score of 0 in ETF2, and I highlighted the possibilities back then of it being an overreaction and potential value play. And in fact, over the last eight weeks, it's moved up to 70. Lisa says, what do I mean when I say pile on? I mean buy it with discretionary money short term. So let's say on Monday I have money to spend and I don't have any, there aren't any swing trade patterns firing because the market's done nothing but go up. And if I don't have any patterns to play, and let's say none of the Max Payne candidates are working, I'm ready to do yellow zone trading on the small caps and the mid caps if they're outperforming SPY. And so when I say pile on, I mean taking my short-term money and buying the double leveraged ETF on a one-day basis for intraday yellow zone trading. That's what I mean by pile on. It's using the relative strength analogy. Latin America and emerging markets are both white and green. That's pretty good. Brazil at 64 is in the green. EWZ has been better than ILF, which has been better than SPY. And so I have been playing Brazil intraday, a day at a time, throughout this little march upwards. Sweden is the only European country in the green. Most of Europe is in the yellow. You can see the big indexes in the European region are all yellow. Among the commodities and the specials up top, oil and silver continue to distinguish themselves. Gold has actually lagged a little bit. The blended commodities are in the middle. U.S. real estate is lagging. In the business sectors, only energy in both U.S. and global are in the green, and industrials and materials are in the white. So the defensive sectors have started to give back a little bit of their strength, and that's a quick look at the world market model. On the 100 by 200 crossover, that's the next chart. The price improvement has happened all around the world, and now all of the indexes except for Japan, utilities, and treasuries are back on a buy condition, favorable condition, and that means that their price is better than the 100-day moving average, which is better than the 200-day moving average, and so that's a long-term measure of intermediate term strength or long-term strength. They're very favorable on technical conditions. Next chart, number 8 of 9, is the top 30 in the ETF2 database, and it continues to be dominated by anything that's an energy sector or precious metals, and you'll see even the U.S. mid caps are getting back into it. CUT is a timber index, and that's looking good. EWY, South Korea, is in the top 30, and so once again, anything commodity and energy based is looking pretty good. Taking a look at the ETF liquidity, the top 30 remain the top 30. Pardon me. And those highlighted in green under ATR percentage are those that are exceptionally volatile intraday, and so they offer opportunities for intraday trading using ETFs. And so I like silver and the VIX, the gold miners, GDX. The volatility is actually coming out of Japan. It was 3.5 last week. It's now under 3. And then semiconductors and metals and mining continue to be volatile, and that's good for us short-term traders. Okay, so I'm going to shift now to the daily report, daily trading plan. Let me get that set up for you. No change to the market mosaic things. I would say under the gap stats, the patterns have changed and have gotten back to just about neutral. You can see right now that the numbers of times it has gapped up and gapped down has leveled off at 15 each, and then the follow-throughs have leveled off. You may recall, 2 or 3 weeks ago that the market's follow-through was heavily weighted in one direction over the other, but now it's back to just about parity, and so that's how quickly the gap pattern can change. I would note, however, that the two failure options, gap down and drop, averages a 0.7% follow through, and then the gap up and reverse to a fail has been averaging 0.78% follow through to the downside. In both cases, that's larger than the follow through when the market has continued to gain. So right now, the intraday trade is favoring the short side intraday. That's how I read that. Not much change in the range stat. You can see on the 10-day NDX that the market has been overbought for a number of days and continues to be overbought. There's no signals in the overreaction and the short side. I'd like you to notice the SPY volatility, the ATR percentage. It has pulled pulled back from 1.75% daily ATR percentage all the way back into the normal around 1.25, and that pullback in volatility has corresponded to or gone hand in hand with improved performance inside the market. There are no patterns that fired on any of the formal swing trades, so I tend to look for the max pain candidates like Bank of America and American Express, and then the three in the middle, Hewlett Packard, Intel, and Cisco, all coming out of the technology sector. So technology has been a laggard, and finance has been a weak sector, so it's not surprising that those five are found in the 10-day max pain. Among the ETFs, it's the VIX, natural gas, Japan, semiconductors, and the gold miners. If you're looking for the momentum leaders, the performance leaders on the 10-day min pain, it's IBM, Kraft, ExxonMobil, Procter & Gamble, and Coke. And then PFF is an ETF that's built on the preferred stock that pays a high dividend and is an extra layer of safety using U.S. large caps. EWI, South Korea, USO, oil, and XLU, the defensive sectors of utilities among the S&P. It actually has some telecom in it too. Inside the ADX indicator in the southwestern corner, you can see that ADX has pulled back below 20. It's down to 18.7. But now plus DI, the green line, is above the red line. And so that says that the bulls have regained their momentum and their strength. And now with an ADX at 18, there's room for the market to continue its bullish tendencies and actually develop a bullish third leg up. And if it does that, historically, that's been an 8 to 10% move. If you take a look at the last two legs up, both of those were in excess of 10%. So if this is the starting point for an initial, an additional 10 to 12% move, there's still room for it to continue. Next chart up, looking at the pattern summary for the Dow 30. There are no patterns. There's plenty of dojis from Friday. Not surprising if you take a look at SPY's chart pattern. It was a big gap up and then a narrow range day, and that's the definition of a doji. To get back to Mike Jones's question, that's also a classic pattern that could be interpreted later as a evening star. A high gap up and then a rollover point. So we're going to be prepared for that. We know that the follow through to the downside has been favorable, and we know how to trade that intraday. You can see the percent winners and losers in the symbol column. You can at the very bottom you see Intel and Cisco have been percent losers by any measure of the time frames. I'm wondering if you guys can hear the sound of that of all that hail hitting my windows outside. It sounds like damn shotgun. Coca-Cola and Caterpillar have been in the green, so that's your momentum winners, and then Intel and Cisco have been momentum losers. I would like you to take a look at Alcoa right in the middle of this chart. This is how I use this chart. Alcoa is one of my favorite trading targets. You can see that in the 10-day through 6-month look-back period, it's highlighted in green, meaning it was a extremely strong in terms of performance compared to its peer group in that period. Only lately, in the last 1 day, when it lost 1.1%, that puts it into the red. And so I look at Alcoa as a long-term strength leader based on commodity prices and basic materials, but which has had a 1 or 3 day pullback here, really a 1 day pullback, and that suggests to me that I'm prepared to buy it on a dip if I see any kind of strength in Alcoa. It looks to me like Alcoa is on sale. Moving on to the ETFs. Again, no patterns, only a couple dojis to look at there. XLY is the consumer discretionary coal, and the diamonds are in a doji, as is the utilities. Percent winners on Friday: oil, emerging markets, Latin America, and Europe. So I really like emerging markets in Latin America as a continuation play on momentum. And then the percent losers, the VIX, natural gas, gold, and technology. So if they start failing, I'm prepared to play them on a one-day intraday basis as well. Moving on to the additional mosaic indicators. Upper left-hand quadrant, the 30-day regression line, the blue line, the slope of that line is what creates the time series to the right of it in the northeastern corner. You can see that it had a 3 standard deviation pullback on this correction, and it went from +1 standard deviation all the way down to -2. It crossed over its 10-day moving average about a week ago, and then has been improving steadily ever since. When it crosses over its own 10-day and reverses direction like that at an extreme distance from average, which is the black line, I treat that as a significant signal, as a potential turning point. And as you look down to the southeastern quadrant, that lines up day by day. You can see that actually signaled a move that allowed about a 5% potential return. On the percent stretch above the 200-day moving average on the lower left-hand quadrant, it pulled back from almost 20 back down to 7 or 8%. That's a 12% pullback, and has now come back up to the 1 standard deviation above average. I want to draw your attention finally back up to the northwest quadrant here, the 30-day regression line. The R-squared symbol statistic is at 0.01, and that if it's exactly at 0, it means that the regression line is the poorest possible predictor or descriptor of that price action. There's so much price behavior on either side of the line at extreme distances. What it tells you is this is potentially a turning point from one trend down to a trend up, and it's right at the tipping point. And that kind of gets in line with the price testing the previous swing high. This is the teeter-totter is perfectly balanced, and it can go in either direction, and that's what that R-squared statistic tells us about the price action around the regression line itself. But it actually has had quite a significant performance improvement over the last 10 days. Okay, so moving on. Let's see, the range stat just references, the gap stat references. Self-explanatory on the quality charts. Let's see, the only one I want to talk about is the very last page, page 15. This one examines the 30-day correlation coefficient among the major indexes compared to SPY. What you see right now on the chart on the right, this one reports the z-score of the correlation coefficients. In other words, it factors out their historical volatility, and so it computes it on a standardized basis. The least correlated of the major indexes to SPY right now is this pale blue, and that's or this medium blue. That's EWJ Japan. Japan has been hammered so much while the U.S. has been going up that it drives the correlation coefficient way down. It has drifted out of correlation with the U.S. How does R-squared coincide with the regression slope? Wayne asked me. The technical answer on that one is R-squared tells you what percentage of the price data can be explained by the underlying regression line. When it's at 0.01, it tells you that the regression line is a very poor predictor, cannot be used to predict where price is going to go. There have been times when we've seen 30 days of price action exactly in the same direction, and we've seen the R-squared coefficient go to 0.99. And what that means is that you have good reason to believe that the trend will continue when the R-squared statistic is at. It basically says how well does the regression line explain the data, and can it be used as a predictor. When it's at 0.01, it's horrible. It's related to the idea of a confidence level. It has to be above 0.5 before you can even begin to think about it having a predictive value. And you can only really do that when you have confidence that the underlying process is somewhat normally distributed. When it is abnormally or unnormally distributed, like the market is, then you can get into trouble if you put too much emphasis on the correlation coefficient. But when it's when R squared is at 0.01, it just means that we are at a perfect place for a turning point in the trend. What I want you to notice is that EWJ has moved way out of correlation with the U.S., and then the other ones are stacked up in various levels. SPY is right at right at 0. What I do is I measure the distance between the most correlated and the least correlated, and then I plot that as a time series. And what you'll notice is that when there are large peaks, that tells you that the correlations have been getting very wide. And what all this really means is that when the market is going up, the correlations tend to weaken as money aggressively seeks to find the area or the region that's doing well or doing better than SPY. But when things start going south in a hurry, the correlations all converge very quickly back towards SPY, and so all those previous assumptions about where the relative strength is can go right out the window. So it's part of the market mosaic. Where we are right now, we're at 1 standard deviation above average of the last 100 days, and that means that the markets are relatively strongly correlated here. And I think it's because they came together so much during the pullback caused by Japan and the Middle East. Okay, I want to shift now to the charts of interest and show you something I've been noodling around with with the MACD histogram. Now these charts are uploaded for you also in the chat room, so it'll be a little bit easier to see in there. And so there's 2 pages now. The charts on this page are what I would call my my usual suspects. Excuse me. These are the ones that I'm always interested in all the time, no matter if they fire a swing trade pattern or not. I just like to know where they are because these are my candidates for RFA trading. And it's a mix of large caps and then liquid ETFs. I'm using the candle glance feature from stock charts, and so that lets you put a whole lot of charts on one single page. If you have a wide screen, you can actually look at about 25 different charts at once. And as far as what will fit on PowerPoint that's readable, I've narrowed it down to 12. It doesn't have a whole lot of flexibility about what additional indicators you can put on there, but that actually is not a bad thing. What I've shown here are simply the 50-day moving average in blue, the 200-day moving average in red, and then the MACD histogram on a daily basis. That's the lower indicator. And what I've done is I've put a green circle around those locations where the fast moving average, that's the black line, crossed over the slow moving average, the red line, and then just drawn a blue arrow to point up to where so we can see what the price action was doing after that. Now, what I want you to notice is that in a bull market, crossover, when the fast crossovers the slow below the signal line, we get an uptick. We would have had upticks on the MACD histogram a little earlier. That's sort of the basis of that WMV strategy for improving entries, the Williams percent R. If the fast-moving average is below the signal line, chances are you will have seen Williams percent R fire an oversold condition just because the way the 2 indicators are constructed. In the default settings for MACD histogram, the fast-moving average is a 12 period, and so it's looking back 12 candles, and Williams percent R 10 is looking back 10 candles. So when you see an extreme move to the downside in MACD histogram, it's not unusual for the W in WMB to have fired. And so in most of these cases, what you will notice is, in Alcoa, for example, the MACD histogram or the MACD crossover occurred right around 16.5, and it's moved up $1 since then, and that's about a 6 to 7% move. It coincided with a crossing through the 50 and the 200, and that's really favorable. So you can see with just a little bit of technical analysis, nothing fancy. You don't have to get the timing exactly right. You can actually do some good things. You actually would have, if you looked at the WMV, you could have gotten in on Alcoa around the 18th of March, around looks like about 16 on that little black candle that first came out of that support level. In Boeing, you can see the positivity there in that crossover. Same thing in Caterpillar, and look at the move. It has never looked back. Now Cisco is one where it didn't work, and so right around March 7 on the first little crossover occurred. No follow through. If you had tried playing that, you probably have taken a 1-hour loss in Cisco. Lately, it's given another one. You may not be out of that one already because it hasn't broken below 17. But Cisco and Hewlett-Packard on the third row, both of those have failed to follow through along with the rest of the technology sector. So their rebound is still ahead of them, and that's why I'm very interested in the technology sector, because it has lagged behind the rest of the market in this little bounce. You can see Chevron, however, had a nice follow through after it did its MACD histogram crossover. The same with DBC has had a nice follow through. Asia less Japan. Brazil has been absolutely brilliant, as has ILF on the lower right-hand corner. The ones that have not followed through yet, I would say DBA has not had its move yet. It's crossed over, but it hasn't exploded up yet. I still see it going potentially to 35.5, and that's another 6 to 8% move inside the agriculture sector. Moving on now to page 2. You're going to see basically the same kinds of patterns. Intel had a crossover but failed to follow through and probably got a 1-hour loss on that one. However, it's right back to its swing low around 20, and that's why I'm interested in it, because it's kind of in a max pain condition. We already know we saw it on the max pain, and it's easy for me to see the upside to it and a very measured risk on the downside. The small caps, getting back to Ali's question and observation before, you can see IWM has already taken out its previous swing high at 64, and so there's no resistance overhead. If we see any kind of strength in SPY, it wouldn't surprise me that the small caps are doing better, and that takes me right to UWM, the 2 times leveraged small cap ETF. And yes, Lisa, I will pile on if I don't have any better ideas. Johnson & Johnson had a nice little crossover earlier at the end of May. It still has plenty of room to go. It has not even gotten through its 200-day moving average. It can get back up to 62 before it even retests its previous swing high, and that's a stock that fund managers must own. Kraft right next to it has been a strength leader. That was on the 10-day min pain, and you can see why. It had its little crossover on the 28th of March and never looked back. If you're looking at the WMB pattern on a daily basis, you end up getting into that one around 30.5, back around the 21st of March, and it never looked back. It never went below the swing low. Coca-Cola, much like Kraft, has been something everybody has to own. It blasted through resistance at 55 and is now up at 57 and no resistance overhead. Coke and a hamburger, right next to it is McDonald's. You can see the crossover. Right at 75, it's at 76 and charging. Same with mid caps. Mid caps have been the strongest of the U.S. indexes and the strongest of the big regions in the world. And so there it goes. It's at 180 and continuing to go. Lisa asked me, would I do that in terms of RFA and just buy it with a loose stop, planning to hold all day? Yes, I would. If I don't have any better ideas, that becomes an RFA day trade, and then I'm willing to hold that overnight, because I wonder if I just violated one of the rule sets that I gave you there. Maybe I have to say no, I shouldn't hold it overnight, but I would tell you it's a bull market, It's back to normal. Small caps and mid caps are the strongest ones. If you had to hold something overnight, you could do a lot worse than small caps in that kind of condition. Particularly, you could buy it with a 3 times ATR for overnight, and that would be good to go. Wayne asks, to trigger WMV, does Williams percent R have to stay below -80? No, it can't, because the uptick that causes the improvement in MACD histogram, because of the way that is calculated, it must go back above -80. Otherwise, you would never see the uptick that would cause you to fire the second rule. So all it ever has to do is touch -80, and then that tells you the first condition was met, that at one time recently it made a dramatic oversold condition, and now the MACD histogram uptick tells you it's getting better, and that's all you care. You don't have to, that once the rule is in place, it just keeps going. And when it makes its move like this, it's going to move in from 5 to 7 days. So if after 5 to 7 days you don't have an uptick in MACD histogram, well then you end up, you never get into the position, because it never triggered the second rule. So it's actually a pretty nice filter for you. You can see that I like Microsoft. Now, I'd like you to remember the patterns that we saw in Intel, Cisco, and Hewlett-Packard. Those had both failed back to previous swing lows. I want you to look at Microsoft pretty carefully here, and let me see if I can make that larger for you. It actually has made a higher swing low and found support on its 200-day moving, or its 50-day moving average at 25.5. It's not failing. And so if it breaks out from here above 25.5 and then through 26, then Microsoft is going to be the strength leader, taking the technology sector back north. It is the best of the beaten down techs to lead us higher. Same thing with Walmart. It had a swing low around 51, has not pulled back to test that. It found support at 52 on its 50-day moving average, and the 50-day moving average has actually turned positive, and now you got a target at 54, 55, and 56. So if we see continued strength in the U.S., if SPY gets above 135, then Microsoft and Walmart must do better, and they're going to be strength leaders going forward, so they should be on your short list and ready to pile on them if you see them outperforming SPY. You can see how the VIX has trailed off from its the days of wine and roses up there around 40, has pulled all the way back to 27.5, which is where it was on its previous swing low. So that as the volatility has come out of the market, the VIX has suffered, and SPY and the other indexes have been going up. So those are the charts of interest. So I really want to draw your attention to the power of and the usefulness of that MACD histogram. You've seen me use it most of the time on intraday basis for improving my yellow zone trading. And as Hunter has observed and Travis have observed in the seminars, hey, there's nothing wrong with the WMB on a daily basis either. And that's one of the reasons why we put it in bundle number 1 for the TradeStation trade management patterns. That's actually a 7th swing trade system that we've included in that package. So that's everything that I wanted to brief you on tonight. I've been recording this last little section here, so these remarks will be available. It usually takes about half an hour to an hour to process a sound file this large, and so at some point tonight it'll be available on YouTube, and I'll send that link out to everyone and also post it in the chat room. Yeah, Lisa asked, you didn't see the charts in the chart. I think I posted them right after you had left. They are there under, there is a PowerPoint file in there called COI 2011-0402. That's charts of interest for this weekend. They're in the chat room. Yeah. So I'll hang around for a couple minutes here yet. I'm going to stop recording so I can start processing, and I'll hang around for a few minutes yet. Sorry to go over. Wayne has asked, the yen's been going down. Is that a major factor affecting EWJ? It has to, because it's gonna crush the values of all the companies whose assets are denominated in yen. So that's they're getting hit from both angles, both from the equity markets and then from the currencies. It wouldn't surprise me if that's why they're talking about stopping buying treasuries, and that's that I think is what's motivating the Congress to start talking about cutbacks and entitlements in a serious way for the first time in recorded memory. I mean, cutting $4 trillion out of the budget, that's some heavy cutting right there. Hopefully they'll get it done. Yeah, Paul points out nice ABC pattern on Intel. Absolutely, it's good. I mean, I really like that that pullback. You know, that Friday I look at that big red candle as a washout. It shakes out all the weak hands that were nibbling their way in, but it never violated the swing low. So if it turns around from here, that's going to be a brilliant trade. Garen asks, do I have any plans of doing another live trading in KC this year? There seems to be enough interest out there to do one in July, and at least I'm gonna head over there and make sure. Let me see what I can find on that. I think it looks like in the last week of July there was interest in doing it. I think it was somewhere around the 25th to 30th of July. I get the exact dates wrong, but it's about in that ballpark. I've got some seminars to teach for IITM in, I think, September and October. So, basically I'm willing to do them in Kansas City if we can, whenever 10 people are interested in doing it. I can do that. We got a pretty nice hotel identified over at the airport, and they treat us pretty nicely. And that's kind of fun. We do a pretty low overhead, and so I could see doing. We'll definitely do the one in July, and then maybe November is probably the next time I could do one. But if there's, like I said, if 10 people are interested, I can I'm willing to open up other dates as well. Just